quick transition to Dr. Dennis Foster, the second member of our presentation in the dynamic trio, if you will. Dr. Dennis Foster not only takes part in this event every year, he also leads an economics club on campus. He does a lot of things for our economic students, who are, several of them are here today. So again, we thank you for continuing to be involved in this great event and look forward to what you have to say.
Thank you very much, Wade. Thank you. It's always a pleasure and honor to speak to you at this event. Wade did pass me a note to make sure that I thank the CEO of Alliance Bank, Dan Garvey. Thanks for coming. I'll make sure I got that. All right, before I get into more serious material, I thought I would share this with you. About a month ago, the Flagstaff Convention and Visitors Bureau had this mural painted on the intersection downtown Flagstaff. And they want to continue their efforts this next spring, but they've reached out to the community for some ideas. And surprisingly enough, the Friends of Flagstaff Future have submitted an idea, and it includes Ron and Elliot and I in this. And it's kind of interesting. I think you'll like it. There's a pine cone motif. They're going to use our pictures, which that's pretty cool. But I'm not sure that the CDB is going to be keen about the slogans they want to put up there. But at least it does grab your attention, so that's there is that. All right, today what I want to do is provide a quick review of the economy, what I've called the good, the bad, and the ugly. Then we'll look at some policies of the Federal Reserve in terms of how we got to where we are today, and then finally look at the outlook for the near term for the next year in terms of what I see for it. So we'll start with the good news. Inflation as measured by the Consumer Price Index, the CPI, has been relatively low for a number of years. This chart shows the CPI inflation rate going back to 1947. Here are the really bad 1970s, where the year-over-year rate got up as high as 15%. And a couple of times over this time span, we've seen deflation back in the 1950s and during the most recent recession. Here's a closer look at the last 11 years of the CPI. The grade shaded in areas, just like the graph that Ron showed, is the last recession, which was December 2007 to July 2009. In the most recent quarter, the year-over-year rate in the CPI is just a little bit under 2%. Now, those relatively low rates are pretty good news for us, although I still have some rather serious doubts about the Fed's policy of trying to achieve 2% as the quote-unquote right level of inflation for the economy. They don't use the CPI, they use the PCE, but still, their mandate is to maintain stable prices, not to maintain slowly growing prices, and I think that's still an issue of concern. Now for some of the bad news. Our painfully slow economy recovery, as Ron has pointed out as well, as measured by the real GDP. This chart shows quarterly growth going back to the 1980s, after the 1981 recession. We've had 4 recovery phases during this time, and I've associated them by the presidents in office over those recovery phases. And what you can see there is that each recovery is getting worse and worse and worse in terms of its overall performance. Here's the aggregate growth in real GDP over these recovery phases, and you can see that we've been on a downward trend. Our current recovery, though, is 33 quarters long, and it's likely to last a little bit longer anyway, but still the average growth is not very good. And we can see that here in this particular slide as an alternate way to see this. This is the annual average rate of growth in real GDP in each of these recovery phases. In the 1980s, we were going at over 4% per year, and in the most recent recession, just a little over 2% a year. Now, when I look at that graph, I think this is the biggest issue we face, although apparently Russian hackers are a bigger one, so I'm not sure about that. One more way to look at this, here's the annual growth in GDP going back to 1990. What I did was I shaded in the bars. The dark ones are over 4%, the orange ones are 3 to 4%, the blue ones are 2 to 3%, yellow is 1 to 2%, and the red ones are negative. And you can see that the last time we grew at over 4% was the year 2000, so 17 years ago. And the last time we grew over 3% in a calendar year was 2005. And again, if this is the new normal, this is very troubling. I mean, our economic future is really up for some questions here if this is what's going to keep happening. Well, that was some of the bad news. I actually have some other ugly news. And that is, I want to look a little bit at the burden on the private sector in terms of what is going on as well. The slow growth is in real GDP, and here it is from 2000 to 2016, growing at 1.8% per year. But that real GDP includes government spending. And government doesn't create wealth. Every dollar that the government spends has to come out of the private sector. That's where the money comes in order to fund government activities. So you can think of the government as a burden on the private sector in that regard. You can also think of a lot of indirect burdens, and that would come in the form of regulatory rules and regulatory costs. So recent estimates put these costs at upwards of $2 trillion a year, which is really quite astounding. And that only includes federal government, not state and local. So what I've done is I've subtracted out some of these government burdens and created a measure I call the adjusted, go back a little bit, the adjusted real GDP, which are the darker colored bars there. And they've only been growing at about 1.13% per year over this 17-year period, 17-year period. And the difference between those two rates, the 1.8 and 1.13, is not sustainable. That's the whole point here. You can't sustain this over time unless your ideal outcome is not to have a private sector. I hope that's not your ideal outcome, because that's where we're headed. So what about the Federal Reserve? Well, what they want, of course, is they want to promote maximum employment, stable prices for the foundation of a healthy growing economy. What they do is they basically try to change the money supply. Actually, what they do is change the monetary base in order to try to affect the economy. They've been concerned about the slow economic growth and unemployment for a number of years, so their primary purpose is to try to increase the money supply to drive down interest rates. Driving down interest rates typically would increase spending. That'll increase employment and production and lead to a hopefully healthy growing economy. If the opposite happens, then what they do, if there's inflation, they would tend to decrease the money supply and increase interest rates. Now we can see the details of some of their actions by looking at their balance sheet over the last 10 years. This is the Federal Reserve. You can see that it's gone from $800 billion just before the recession to $4.5 trillion as of now. And that's a very dramatic change, and yet we've just seen that it hasn't really done anything to our economy. We're growing much slower than we have in past recessions, so one has to question whether these kinds of policies are even effective. And just to put some context there's where Ben Bernanke was the chairman, and there's where Janet Yellen was the chairman. And she may be the luckiest person ever. Because President Trump didn't reselect her, whenever we have our next problem, it's going to be blamed on Jeremy Powell, or it's going to be blamed on Ben Bernanke, and so she's going to look pretty good as a result. So good for her. Now on the asset side, so what I want to look at is assets and liabilities here quickly. The Fed's holding two major assets. That is U.S. Treasury bonds and mortgage-backed securities. Right now they're holding about $2.5 trillion of U.S. Treasury bonds, about $1.8 trillion of mortgage-backed securities. Now if they want to try to undo this in a timely fashion, they have to sell off these securities. That's going to raise interest rates, and that's likely to send us into a recession, so that's not likely to happen. This last month, the Fed started what they call normalization, a very tepid policy right now to sell off, actually not even to sell off, just to allow $10 billion worth of these securities to mature and not reinvest these proceeds. They plan to raise that up over time, but I can't imagine that we're going to have nearly enough time for them to have this plan work out to its presumed end result before something bad happens. On the liability side, there are also two major items. One is currency that the Fed has created. It's about $1.5 trillion. And the other is bank reserves with the Federal Reserve. Most of these are excess reserves that are available for lending, but aren't used that way. It's almost $2.3 trillion. So what that means is that the Fed has created an enormous amount of bank reserves in the system as part of the monetary base, but that hasn't really led to any dramatic increase in economic growth and development. Indeed, if banks decided to lend out this $2.9 trillion, what we'd have is enormous inflation, and that would be our big problem. We can take a little closer look at some of these monetary figures here by comparing before and after the last recession. This is the growth rate in the money base, which the Fed controls, and the growth rate in the money measure M2 and the Cpi inflation. And before the recession, you can see from 1990 to 2007, the monetary base was growing about 6.5% per year. The money supply of 2 was growing about 5% per year. Inflation was about 2.75% per year. Since then, the monetary base has grown at more than 16% per year. But it hasn't translated into much with regard to money supply growth and inflation. You can see that money supply growth is up a little bit, 6.4%, and the measured inflation is actually a little bit lower at 1.8. So let's turn for a couple of minutes to interest rates. The Fed primarily targets the federal funds rate of interest. This is the rate going back to 1955, and you can see that after each of the last 4 recessions, they've pushed the federal funds rate down to lower and lower levels in order to deal with and try to compensate for those particular downturns. But the problem, of course, is they've pushed it down as far as it can go. It can only go to 0, and that's going to be it. Here is a closer look at the last 11 years of the federal funds rate. It was a little over 5% before the recession, and then for 7 years it has been at or near 0. Unprecedented, and still we haven't paid the price for that, but I think we're going to have to pay the price. They've timidly started raising this a little bit last year to 1.15%, but the last 3 meetings they've decided not to do anything to further raise that, although I think that it is going to go up. Here's the federal funds rate with a couple of other interest rates to give you some context. The prime rate of interest running about 4.25% right now, and the mortgage rate of interest, the average 30-year fixed rate, about 3.9%. Those rates move together. They don't move. They aren't perfectly correlated. You can see the longer term tends to show more volatility as a result. So, what has the Fed done? Over the last 10 years, they've really put themselves into a difficult position. If they try to unwind their balance sheet, if they go through this normalization process too fast, interest rates could go up, we can end up with another recession. But if we do have a recession, there's nowhere for them to push interest rates down. They're already down to 0, so there's nothing much else they can do in this particular regard. So there's some troubling questions that we have here in terms of thinking about the future with regard to the Fed and monetary policy. One is, can they actually stop the bursting of another bubble? We'll see whenever that happens, but it's going to be a very interesting thing to watch. Also, what will the Fed buy next time? They started buying mortgage-backed securities last time. Are they going to start buying car loans, student loans, corporate debt? Japanese are already doing that, so it's a very interesting question too in terms of what they're actually going to buy. And what's the next recession going to look like? I don't think it's going to look anything like what we've seen before. I mean, I think it's going to be horrible, but I think it's still a ways away, so you can try to hunker down and buy as much prepper food as you can. Well, that brings us back to growth. If we can get past some of these monetary hurdles that can wreck the economy, there are still some positive developments, I think, going on in the economy. One, of course, is the proposed tax cuts. That's a little bit of a start in this regard, but really our problem at the federal level is spending, but politically you can't ever do anything about that, so I'm not really all that hopeful, but still there's a lot of hope on the tax cut front. And then we've got some interesting developments in terms of regulatory reform, regulatory cuts. That's been started already. I think that's going to continue, and that could be a very positive thing to happen to our economy. And there are a lot of different fronts on which that may occur, perhaps on the environmental front, the banking front. Maybe if we keep our fingers crossed, maybe healthcare will be affected there too. A very interesting development would have been to have President Trump select John Taylor to be the Fed chair, but he didn't. He picked Jeremy Powell. But that would be kind of interesting to have seen. Taylor's a well-known economist for having a rule in terms of how the Federal Reserve should operate instead of using discretion. But there's still some talk that maybe he'll get offered the vice chair, so it'll be interesting to see how that plays out. And then finally, if President Trump keeps tweeting, and I don't think he's going to stop, maybe some positive changes can occur, and it will take place under the radar of the media. So we'll see if that happens. Turning to my outlook, I think the Fed balance sheet remains a threat to our economy, and I don't think that's going to go away anytime soon. Having said that, I actually have some optimism for this next year, kind of like Ron. I think that GDP growth is going to go over 3% next year. So that'll be the first time in 12 years. I think that's going to be a positive change. I think that's going to bring with it a couple of other things. Interest rates are likely to go up. I would expect a year from now the Fed's target federal funds rate is going to be at least 2%, maybe a little higher than that, not much higher, but I think that they'll be raising those rates if GDP growth continues at about 3.2%. But I also think inflation is going to creep up past their benchmark. I don't think it's going to go up much beyond 2%. And I think next year will be good. Years after that, I'm not so sure, but at least next year I think it's going to be pretty good. Well, before I turn to my top 10, I did want to take a moment to mention that last spring, Ron retired from teaching at the Franke College of Business. He was a great leader for us in the college, and his willingness to stay involved both in the college and this conference has been really awesome, really appreciate it. Wanted to thank you. Pretty sure he taught there for 100 years. Well, then I think you'll especially like my top 10 list. It's the top 10 forecast, economic and not, made by Ron Gunderson. Number 10, in 2007, within a year, the Dow Jones will reach 25,000, mostly on the strength of housing stocks. Number 9, in 2012, they may say a businessman can't win the presidency, Mitt Romney will show everyone wrong. Number 8, 2017, this year's Academy Award for Best Picture, La La Land. Of course, if you saw that for 30 seconds, he was right about that. Number 7, in 2001, I'm getting rid of all my Enron stock and putting it into Lehman Brothers. Number 6, voters in Flagstaff understand basic economics and will never raise the minimum wage. Totally wrong. Number 5, 2015, data breaches are history. I have absolutely no concern about my personal information online, be it at Yahoo, Equifax, or Ashley Madison. Number 4, in 1977, Smokey and the Bandit is a franchise that has a bright future, unlike that awful Star Wars. Number 3, in 2008, the business model for Facebook is flawed. You won't be sorry you kept your MySpace page. Number 2, in 1985, CDs will be just another short-lived fad, but I'm bullish on 8-track tapes. And the number 1 forecast, economic or not, made by Ron Gunderson, 1970, 1974, 1975, 1977. Who will be the Super Bowl champs? It's the Minnesota.
Oh, my King, let him again. Oh, my King, honor your name. Go get that first down and get a touchdown.
Well, this year they're pretty good, so this might be the year. I don't know. Maybe they'll make that much more. Thank you very much for your time.